Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Louis, and I'm excited to have you join us today. We're going to explore a fascinating topic that's been making waves in the financial community: the buy, borrow, die strategy. This strategy has been popularized by some wealthy individuals in the US who use it to minimize their tax liabilities and pass on their assets to their heirs with minimal friction. But how does it work, and is it relevant to our listeners in the UK and beyond? The basic idea behind buy, borrow, die is that you buy assets, such as stocks or real estate, and then borrow against them to fund your lifestyle. This allows you to keep your assets intact while also minimizing your tax liabilities. When you pass away, your heirs inherit the assets, which are rebased to their current market value, effectively wiping out any capital gains tax. However, as we'll explore in more detail, this strategy is not without its challenges and complexities. In the UK, for example, inheritance tax can be a significant hurdle, with rates of up to 40% applying to estates above a certain threshold. This means that even if you're able to minimize your capital gains tax, you may still face a substantial tax bill when you pass away. To illustrate this point, let's consider an example. Suppose you're a UK resident with a portfolio of stocks worth $1 million. You borrow against these assets to fund your lifestyle and then pass away, leaving the portfolio to your heirs. While the portfolio will be rebased to its current market value, your heirs will still face a significant inheritance tax bill, potentially up to 40% of the portfolio's value. So, is buy, borrow, die a viable strategy for our listeners, or are there better alternatives? We'll be exploring this question in more detail and examining the pros and cons of this approach. We'll also be looking at some alternative strategies, such as sell, gift, die, which may be more suitable for those looking to minimize their tax liabilities. Before we dive deeper into this topic, I want to emphasize that tax planning and estate management are complex areas that require careful consideration and professional advice. It's essential to consult with a qualified financial advisor or tax expert to determine the best approach for your individual circumstances. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and markets, where the stakes are high and the players are always on the move. Today, we're looking at two stories that showcase the complexities and intrigues of the financial sector. First off, let's talk about Adani Power, which has been making headlines with its recent developments. The company has secured a major contract, and investors are watching closely to see how this will impact their bottom line. But what does this mean for the broader market? We'll break it down and give you the lowdown on what to expect. And then, there's the story of Nifty rising for the second consecutive week. Despite foreign institutional investors continuing to pare holdings, the Indian equity market is showing signs of resilience. But what's driving this momentum, and can it be sustained? We'll examine the key time clusters that traders are watching, including September 18 and 19, which are flagged as crucial dates. It's a delicate balancing act, folks, with multiple factors at play. As we navigate these complex market dynamics, it's essential to stay informed and adapt to changing circumstances. Whether you're a seasoned investor or just starting out, understanding the intricacies of the market is key to making smart decisions. So, let's take a closer look at these stories and what they mean for your investments. We'll provide you with expert analysis and insights to help you stay ahead of the curve. And remember, in the world of finance, knowledge is power. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic discussion so far, and now it's time to wrap up with our closing segment. As we always do, we'll be taking a look at some of the latest news and trends that could impact your investment decisions. Today, we're going to talk about mortgage rates and the housing market. If you're in the market for a new home or considering refinancing your current one, you'll want to pay attention to this. According to recent reports, mortgage rates are at their lowest point since October 2024, with the national average 30-year mortgage rate sitting at 6.28%. This could be good news for buyers, as it may make it easier to qualify for a loan and reduce your monthly payments. However, it's essential to keep in mind that mortgage rates can vary by state and even zip code, so it's crucial to do your research and shop around for the best rates. Additionally, while rates may be lower now, economists don't expect them to drop significantly before the end of the year. We also want to remind our listeners that adjustable rate mortgages are becoming more popular, but it's essential to carefully consider whether they're right for you. With an AIRM, your rate is locked in for a predetermined period, and then it can change periodically. This could be beneficial if you plan to move before the intro rate period ends, but it also comes with the risk of increased rates down the line. In conclusion, the housing market and mortgage rates are constantly evolving, and it's crucial to stay informed to make the best decisions for your financial situation. Whether you're a seasoned investor or just starting out, it's essential to approach the market with caution and carefully consider all your options. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.